So she's going to introduce all three of you, and then you guys can
Rodney Jones is a professor at Oklahoma Farm Credit Professor in the OSU Department of Ag Economics, with a focus on farm management, transition planning, and agricultural finance. His research covers ag risk management, human resource management, and livestock economics. Dr. Jones earned his master's from Kansas State University and his PhD from Virginia Tech. He'll be followed by Dr. Kim Anderson, a professor of extensive economics in the OSU Department of Ag Economics. His focus is on investment and risk management, grain marketing, and marketing management. His research looks at international marketing, marketing strategies, and risk management. Dr. Anderson earned his bachelor's, master's, and PhD right here from OSU. Dr. Anderson was an assistant extension professor at the University of Kentucky, and I know we all enjoy Dr. Anderson on Sunup each week, what I do is I get to listen to that story for our website. Then, of course, we've got Dr. Darrell Peel, who's a professor and Charles Breedlove Professor in Agribusiness in the OSU Department of Ag Economics. Dr. Peel has served as the Extension Livestock Marketing Specialist since 1989. And his extension program focuses on livestock market situations and outlook and market and risk management education for all of our producers. Dr. Peel earned his PhD from the University of Illinois, and it's going to be a great session of rapid fire, and Dr. Rodney Jones is going to kick it off for us.
The microphone on? Can everybody hear me? All right, great. Hey, it is such a pleasure to be back in this format after last year and all of the massive changes that we all had to make in the way we teach and do extension programming. It is just such a joy to be back here with everyone face to face, seeing a lot of familiar faces. But in the last couple of years, since we've been together face to face, I know I've kind of given this rapid overview of the financial situation in agriculture and tried to bring it back to being relevant to our local community, Oklahoma in particular. I've tried to do this for the last several years, and I know for a good many years the story was kind of the same, right? Times are pretty tough. I hope we can get through until times get a little better. Well, one thing that the pandemic has provided for us is the opportunity to get over that hump, at least temporarily, and for the farm financial situation to look dramatically different than it did just a few short years ago. So I know Rob Fox had this graph up earlier, kind of the USDA ERS estimates of net farm income and net cash income. The overall farm financial picture is showing really remarkable recovery from the 4 or 5 or 6 years just prior to that. Rapid turnaround. Net farm income continues to go up. The last number that you see on that particular graph is their forecast for 2021. And like Rob Fox, I like to focus on that net farm income number, not the net cash income number. Most of the time, that's the one that we try to emphasize in the calculation of true profitability. That's that true estimate of accrual adjusted net farm income. The net cash income number, the yellow line on the graph, is always higher, or at least 99% of the time it's always higher. It's that non-inventory adjusted and not really accurately accounting for depreciation number. One of the things you notice from this graph is as times start to improve, those lines start to kind of converge a little bit. Net farm income as truly calculated starts to converge with that cash income number, because when times get hard, as we were going into starting in about 2014, 2015, we start to tap into our inventories. We start to draw down inventories instead of holding grain over until next year to sell, or livestock and livestock products. We need the cash this year. So we do a little bit less of that inventory holding over. We do a little bit less in terms of prepaying expenses and so on and so forth. So the true net farm income becomes a lot lower relative to the net cash income. As times start to improve, one of the encouraging things when we start to see those lines come back together is we're starting to rebuild some of those inventories. We're starting to prepay expenses a little more aggressively in some of those tactics. But the moral of the story is net farm income is definitely improving. That recovery definitely started to take place in calendar year 2020. Seems to be continuing and even becoming more true as we move through 2021. Net farm income about 20% above 2 years ago. One cautionary point that needs to be made is how big of a factor government program payments have been really for both of the last 2 years, 2021 and going back to 2020, but not quite as big a factor in 2021 as it was in 2020. In 2020, we had the coronavirus food assistance program payments. Those essentially came to an end for most producers in 2021. So none of that in 21. That was a big deal in 2020. While in a broader context, the Paycheck Protection Program was a big deal for the U.S. economy in 2020. It was probably actually a bigger deal for the agricultural sector early in 2021 because of the changes in the rules that allowed self-employed individuals, sole proprietorships, to get a little bit from that program that wasn't available in 2020. I think a lot more people took advantage of that and used that to enhance their income in 2021. Seems like a long time ago, but all those applications were going in kind of in the early months of 2021. ARC and PLC program payments for our crop producers, depending on which program, which commodities, et cetera, et cetera. But as a general rule, those payments are projected to be a lot lower in 2021 than they were in 2020. This graph, of course, is kind of a summary of where we're at with regard to government payments, kind of floating along there for several years at a pretty steady level, a little bit different mix of which payments, which categories of payments comprised that government infusion into agriculture. But then 2020 hit, and you see the big red area on that graph. Those were just payments into the ag sector, coronavirus food assistance, Paycheck Protection Program, along with a few others. You can see it's a lot less in 2021 than it was in 2020, but still a really big deal from a historical perspective. So we'll see if going forward, if we can continue to maintain reasonable levels of net farm income as those government payments continue to shrink. On the other side of the profitability equation, of course, we know that the cost items are just going up dramatically. It's not reflected quite as dramatically in this graph because the final data point on this graph is 2021. It's really going to be the 2022 year, and I think Rob Fox again mentioned this a little bit earlier, but that's where a lot of these cost increases are really going to hit home for our ag producers. As we look at various components of those costs relative to 2020, what is forecast for 2021, nearly every category, of course, for our livestock producers, feed costs are going to go up. That's kind of a two-edged sword when you look at the overall ag sector, because what is an increased cost for the livestock sector is quite often an increased revenue for some crop producer somewhere. but obviously feed costs are a lot higher in 21 than they were in 20. Labor shows up, the bar being quite a bit longer for 2021 there than it was for 2020. Stocker livestock purchases, that would be the third bar there, a little bit higher. Of course, that's all driven by a margin. That one there I don't worry about quite so much. The one that doesn't tell the whole story that is on this particular graph is that one that says fertilizer. A very, very small bump for projected fertilizer expenses 2021 relative to 2020, but wait till the graph comes out for 2022. That one is just going to be really dramatic, really astronomical as we move from 2021 into 2022. A lot of the other categories up slightly, so the overall projection as we look at the calculation of 2021 net farm income, 2021 profitability, pretty much everything contributing to a little cost increase. It'll be interesting to see what happens as we move forward into 2022. Again, it's been mentioned before. Everybody knows this is not a surprise to anyone. This is cost per pound of nitrogen for various sources. Beginning early in 2021, we started to see some dramatic price increases. Those price increases continuing on into the fall of 2021. Of course, the projections shown on the previous two slides were under the assumption that most of those fertilizer purchases were made early enough in the year, either for the wheat crop or even for the summer grown crops, that the dramatic magnitude of this fertilizer price increase wouldn't have kicked in yet. But what are we doing right now? We're buying fertilizer for the 2022 wheat crop. The corn and other producers in the corn belt of the United States are starting to think about what they're going to do for a fertility program for the 2022 crop. This is nitrogen back up to levels not seen since 2012, 2013. This is basically your phosphorus products. The red line, of course, being 2021. Dramatic increases from last year and just continuing to go up. Again, in our ag econ classes, we try to make the distinction when we're talking or when we're talking about economic concepts as to whether we are relaying a fact or an opinion. So the graphs that I'm showing you, that's what's happening. That's the fact. Fertilizer prices are up. My opinion would be I'd be more concerned about this phosphorus graph being a long-term price increase than I would about the nitrogen graph being a long-term increase. Of course, I could be wrong. So I want to be very clear that that's my opinion. But it seems to me like the United States is more in control of what could drive nitrogen product prices, and we're more reliant on other players across the world that are impacting, say, the phosphorus and some of our other fertilizer products. So we might have a better chance of, at least within a reasonable time frame, bringing those nitrogen prices back down a little bit, just due to activities that we can engage in here in the United States, bringing facilities back online, getting some more natural gas production, et cetera. Whereas a lot of the phosphorus products and other fertilizer products have to come from other places in the world. So that's kind of my opinion on that. But definitely these cost increases are going to be a big deal. Based on some survey work done by the Kansas City Federal Reserve, land values and cash rents here in 2021 starting to ramp up fairly dramatically. I guess the good news from this graph that I'm looking at here is, while I think maybe our land sale prices have increased kind of on par with what has happened in other areas of the United States, like is usually the case, our increases in cash rental rates might kind of lag the rest of the ag world, at least the rest of the regions represented on this graph. So the little green bar there for Oklahoma doesn't seem to be ramping up quite as rapidly as it is for Nebraska or Kansas or other areas in the 10th district of the Federal Reserve System anyway. Again, kind of breaking down that increase in land values a little bit. Several years ago, when agricultural land values were increasing generally across the U.S. ag sector, we saw much more dramatic increases in the Corn Belt states and in Nebraska and Minnesota and in other areas of the United States than we saw in Oklahoma. This time, at least based on this survey from Kansas City Federal Reserve, it looks like Oklahoma land value increases early in 2021 have been about on par with land value increases elsewhere. There's Iowa's showing an 18% increase. We're showing a 12, but Iowa's kind of the outlier. Nebraska's at 9, Kansas is at 12, Texas is at 12, if you can't read the chart there. And I think that kind of mirrors what I've been seeing personally as I've watched real estate auctions. Supplies of real estate being put on the market are pretty tight. There's quite a bit of buying interest, and values have ramped up fairly rapidly as we've gotten into 2021. So I don't know what that means, but it's kind of what we're seeing, and whether or not that trend will continue will be interesting to watch. So what are the lenders telling us? This is again based on the Federal Reserve survey from the 10th district. So the darker colored line there is loan demand. The green colored line there would be fund availability. So this would be commercial banks. So that would be certainly just driven by deposits, not necessarily the same story as we might see for, say, the farm credit system or something like that, where the funds are coming from a little different source. But I think the interesting story here is loan demand. Loan demand has fallen off dramatically the last couple of years. The need to increase and renew and continue to borrow money to continue to operate the farm has kind of dropped off a little bit. Does look like maybe a little bit of a spike here very recently as we've gotten into the second and third quarter. But another encouraging sign that the lenders are telling us, at least based on the Federal Reserve survey, debt repayment problems have declined dramatically as we've gotten into 2021 relative to 2020, 2019, et cetera, going back about 4 years previous to the current year. We were definitely starting to see some repayment problems for agricultural loans. Those problems seem to have decreased in magnitude and in number. That's, of course, a very good thing. Interest rates continue to be at really unbelievably low levels in my mind. We talk about this in our ag finance classes a lot. It just amazes me that we can continue to keep interest rates as low as they are. We saw that little bump in 2019 that then President Trump really got kind of angry with the Federal Reserve about, and then the pandemic hit and interest rates came right back down, and they have remained at historically low levels. So how long that can continue, I don't know. As you heard Rob Fox talking about, he's not expecting any really dramatic increase in the next year or so, maybe a little bit of a modest increase within a year or so. Again, based on lender surveys, surveyed bankers reporting higher interest in farm capital spending. As you look at the latest quarter in this report, the second quarter of 2021 would be the blue bars there, up all across the region, up in Oklahoma, up in Nebraska, up in Kansas, relative to even the first quarter of 2021, and certainly well above the levels that we saw during what I would call the farm economic downturn of, say, 2014, 15, 16, up through 2019. Farmers in a buying mood. I don't think that's a surprise to anyone. The question is, can they find anything to buy? So that's what the lenders are telling us, or at least telling the 10th District Federal Reserve. What are farmers saying? Again, Rob Fox alluded to the ag economy barometer that is maintained and coordinated by my good friends, Jim Mintert and Mike Langemeyer from Purdue. They do a survey every month of 400 agricultural producers. It's probably a little more heavily weighted toward Corn Belt producers than it is Southern Plains, but they do get a mix of participants, and it's not the same participants every month. They rotate around to different participants, but they do the survey every month. And let's see, the blue line there represents kind of an index of future expectations of how strong the farm economy is going to be. The other colored line, gold or off gold, whatever it's showing up there on the screen, is kind of the index of farmers' perceptions of current economic conditions. And so as we got into the late spring, the pandemic kind of subsiding a little bit, crop prices really exploding during that era. Of course, farmer sentiment was at an all-time high. It has certainly backed off in the last few months and continued to drop in the latest survey. This survey is a little bit like somebody coming up to you and asking you how you feel at one point in time. Well, regardless of how good things may be overall in your life, if you just walked out of the dentist's office and just had a root canal, you're probably going to tell the surveyor that things aren't going very well today, right? So it's kind of a reflection of an immediate attitude in the farming community. So it's very sensitive to the news of the day, right? If I can't get parts to repair my tractor and I need my tractor to plant wheat, then I'm in a pretty bad mood that day. And as these supply chain issues have started to worsen, I think that may be impacting the last few months of this farmer sentiment survey. You know, things aren't too bad. Commodity prices are pretty good, et cetera, but I can't get my wheat planted. So today's not a good day. So that's kind of my take on what's going on there in the producer survey. Farmers aren't quite as excited about investing in capital right now as they were just a few short months ago. That is true both of machinery and of buildings, as I'll show on the next graph. The green bar meaning that they're more excited than they were a year ago. The red bar meaning that they're less excited. The red bar has been growing, the green bar has been shrinking. So farmers are becoming a little less excited about making machinery and equipment purchases. Again, I just asked the question, is that because they don't have any money to buy machinery and equipment, or because they're just frustrated because they can't get machinery and equipment? I don't know the answer to that. We're kind of in uncharted territory here, right? In my lifetime, we've never experienced a time period where if I had the money to go buy something, I couldn't go buy it because it didn't exist. but we're kind of in that right now, right? I went to Husker Harvest Days about a month ago. Don't tell any of my bosses, they may be in the room and they may pick up on the fact that I played hooky one day. But I went to Husker Harvest Days and walked around and looked at a lot of really nice machinery, and it's really great, but every piece you looked at had been sold many months ago, right? There wasn't anything for sale at this big farm show. They were just displaying what they had, but it had already been sold to somebody else. So that's kind of an interesting phenomenon. Same thing true for buying farm buildings. Are we less excited about putting up a new building because we don't have the money to put up a new building, or because I know if I call somebody and ask them to come construct a new building, they're going to tell me it's going to be a year and a half before I get put on the list? Average price paid for farm inputs. This is again from the Purdue survey. The average increase in farm inputs was about 1.8% per year for the most recent 10-year time period. A very large percent of survey respondents think that this year input prices are going to go up by more than 12%. So a lot of concern out there about rising input prices, and I think rightfully so. We just had a discussion about exports. The gray line represents the number of survey respondents that think ag exports will increase over the next 5 years. The gold line represents survey respondents who think farm exports will decrease over the next 5 years. I don't see much movement in the gold line, so I don't see a lot of producers out there thinking that ag exports are going to decrease, but the number of respondents that think ag exports is going to increase tends to be declining over time, over the last several months of the survey. I guess what that tells me is a whole lot more think ag exports are just kind of going to stay the same. So I don't know whether that's a good thing or a bad thing, but not really super optimistic about our ability to export more than we currently are. Respondents are pretty excited about the value of their primary asset, what's going to happen to farmland values. As a matter of fact, the survey respondents almost unanimously think farmland values are going to continue to go up. And the number of people that think that's going to happen continues to increase over time as that survey question is asked. Going back to just more down to earth on the farm financial measures, for the last several years, we've been really worried about liquidity. Do we have enough cash to pay the bills? We haven't been all that worried about solvency, but we've been very worried about liquidity. Those issues have been dramatically mitigated as a general rule over the last year and a half. Liquidity situation is significantly improved. Loan repayment challenges have eased. We haven't seen, we never saw a dramatic increase in solvency status of U.S. agriculture, but even though we never saw that deteriorate to a very large degree over the last 5, 6, 7 years, the solvency situation is improving as well. So overall, financially, for the average producer across the United States, the ag financial situation has improved fairly dramatically. Liquidity issues have eased, loan repayment issues have eased, solvency continues to improve. If we look at Oklahoma, once again, we have to talk about crop producers versus livestock producers. For 2021, again, this is never a universal statement because there are always exceptions to the rule. But as an overall observation, 2021 will probably be a pretty good year for most Oklahoma crop producers, with the exception of those plagued with serious drought-related production challenges or other production challenges. Even when you consider that significant increase in fertilizer costs and other costs, right now, looking at wheat planting time in Oklahoma, most producers can lock in a pretty decent margin. That's probably also true for many of the summer crops that will be planted next spring, but it's not quite as attractive. That margin's not quite as attractive, starting to get squeezed by some of those input costs. And that's reflected in the price charts that I don't know whether you can see that very well or not, but Dr. Anderson, Dr. Peel will talk about these issues a little more, but the wheat price just continues to go up, right? We can lock in a little better wheat price than we could a month or so ago. The corn price kind of reached a peak and backed off a little bit. Same thing with the soybeans. Last couple of days have been a little bit ugly for especially soybeans. So they're not quite as attractive on a relative scale as maybe the wheat margins. If we look at the cattle situation, look at those recent calf prices, because that's what really matters to most Oklahoma cattle producers. Most are cow-calf producers. Recent calf prices, not that much better than a year ago when we were right in the middle of the pandemic. Feed costs are going to be higher. Grazing costs are going to be higher. Margins are going to be squeezed for a lot of our cow-calf producers. And on top of that, because we were so late getting this much needed moisture, wheat pasture prospects might not be quite as attractive as we would like to see. I just threw this in here just to kind of stimulate some thought. Look at the slaughter cattle price holding up there pretty well, but the calf price has dropped off to not much more than, say, a year ago levels, depending on what market you want to look at, what day you want to look at. Of course, that's a function of the fact that feed costs have gone up, right? The person taking that calf and turning it into a slaughter steer, it's going to cost them a lot more to do that. So they can't afford to bid up that calf price near as dramatically as they could have, say, in some prior years. Government payments have been a significant contribution, particularly over the last 2 years. That support is going to be less in 21 than it was in 20. It's going to be dramatically less in 2022 and probably going forward. So if these cost increases persist, if this fertilizer price increase is a long-term phenomenon, it's going to be tough for these commodity prices to be high enough to maintain decent levels of profitability. If fertilizer prices would mitigate a little bit, we might see a few more years of pretty solid financial performance. So with that, I'm going to turn it over to, let's see, Dr. Anderson's next. If you want, almost every time we do this conference, somebody emails me and wants to get on our Ag Finance electronic newsletter that's sent out quarterly. So there's my email address. And check us out on Facebook if you're not already on the OSU Farm Management Facebook.